Imagine sitting down with one of the most brilliant minds in global investing, a man who has spent decades studying every asset class in the world, from the simplest government bond to the most complex alternative strategy, and asking him just one question: what returns should I really expect from my investments over the long run? That is exactly what this material gives you. Antti Ilmanen spent years at Salomon Brothers, at the Bank of Finland, and then at AQR Capital Management, one of the most respected quantitative investment firms on the planet. He did not write for casual observers. He wrote for people who want to understand investing at the deepest possible level, people who want to know not just what happened in the past, but why it happened, and more importantly, what is likely to happen in the future. This is a work about expected returns, which simply means the returns that investors should rationally anticipate before they put their money into anything, whether that is stocks, bonds, real estate, commodities, or sophisticated strategies used by the world's most advanced funds. Stay with this through to the end, because by the time you have listened to every section, you will understand investing at a level that most professionals never reach. This is not a story about getting rich quickly. This is a story about getting the odds in your favor over the long run, understanding what drives investment returns, learning how to avoid the most common mistakes that investors make, and building a framework that can guide financial decisions for years, even decades, to come. Let us begin. The foundation. The most important idea in this entire work is also the simplest one. Every investment return can be broken down into two parts: the return you expected when you made the investment, and the unexpected return that came from surprises, good or bad, that nobody predicted. This distinction matters more than almost anything else in investing. Most people, when they look at historical returns, see a number and assume that number tells them what to expect in the future. If stocks returned 10% per year over the last century, they assume stocks will return 10% per year going forward. But that reasoning has a serious flaw. The returns you actually received in the past were partly driven by changes in how much investors were willing to pay for assets over time. When investors become more optimistic, they pay higher prices for the same stream of future earnings or dividends. That increase in price produced wonderful historical returns. But it also means that current prices are now higher, which means future expected returns are correspondingly lower. This is the central insight that Ilmanen returns to again and again throughout his work, and it is the insight that separates sophisticated investors from everybody else. Historical returns are not a reliable guide to future expected returns, because past returns include the effect of valuation changes that may not repeat and may actually reverse over time. Think about what this means for a global investor today. If you are looking at stocks and they seem expensive relative to earnings, history tells us that forward-looking returns should be lower than the long-run historical average. If you are looking at bonds and yields are low, history tells us that forward-looking returns from those bonds are also going to be low, because yield today is approximately what you will earn over the life of the bond if you hold it. This is not pessimism. This is simply careful thinking about where returns actually come from, and it is the beginning of genuine investment wisdom. The origins of this framework. To truly understand why Ilmanen's framework matters, it helps to understand the intellectual tradition from which it emerged. For most of the 20th century, mainstream financial thinking was built on the idea of efficient markets. The efficient market hypothesis, developed primarily by Eugene Fama at the University of Chicago, argued that asset prices reflect all available information at all times. If that is true, then no investor can consistently outperform the market, because any information that might help predict future returns is already priced in by the collective wisdom of all market participants acting simultaneously. In its strongest form, the efficient market hypothesis implies that expected returns are constant over time, that all variation in returns is simply random noise, and that the best strategy for any investor is to hold a diversified market portfolio and wait. This was deeply reassuring to many investors and to much of the financial industry because it justified passive investing and suggested that trying to beat the market was a fool's errand. But as the evidence accumulated over subsequent decades, it became increasingly clear that markets were not perfectly efficient and that expected returns did vary over time in systematic and predictable ways. Prices moved too much relative to changes in fundamentals. Valuation ratios predicted subsequent returns. Certain characteristics of stocks and bonds, like being cheap or having recent upward momentum, were associated with higher future returns. These findings did not mean that markets were irrational or that beating them was easy. They meant that expected returns were not constant, that they varied with economic conditions and with the level of investor sentiment, and that careful analysis of current conditions could provide genuine information about what returns to anticipate in the future. Ilmanen's work sits squarely in this tradition. It synthesizes decades of academic research and practical investment experience to build a comprehensive, evidence-based framework for thinking about expected returns across every major asset class. Where do returns come from? To understand expected returns, you have to understand the building blocks of investment returns. Ilmanen identifies several core building blocks that drive returns across virtually every asset class. The first building block is yield. Yield is the income you receive from holding an asset. For a bond, yield is the interest payment relative to the price. For a stock, yield is the dividend payment relative to the price. For real estate, yield is the rental income relative to the value of the property. For a currency position funded by borrowing in a different currency, the yield is the interest rate differential between the two currencies. Yield is the most reliable component of expected returns because it does not require you to predict anything. If you hold a bond to maturity, the yield at purchase is approximately what you will earn over the life of the bond, assuming the issuer does not default. If you hold a stock that pays a stable dividend, the yield is a steady contributor to your total return regardless of what happens to the price in the meantime. Yield is also observable in real time, which makes it a powerful tool for comparing expected returns across different asset classes and different markets. When the dividend yield on stocks is 4% and the yield on government bonds is 2%, the yield alone tells you that stocks are offering more income than bonds per unit of capital invested. Of course, yield is not the whole story, because stocks offer the possibility of dividend growth, while bonds have fixed cash flows. But yield provides an essential foundation for any expected return calculation. The second building block is growth. Growth is the increase in the underlying cash flows of the asset over time. For stocks, this means the growth of corporate earnings and dividends. For real estate, this means the growth of rental income. For commodities, this means the growth in the spot price of the physical commodity. For bonds, there is no growth component in the traditional sense because the cash flows are fixed at the time of purchase. Growth is harder to estimate than yield because it requires forecasting the future. The historical growth rate of corporate earnings provides a starting point, but earnings growth is cyclical and mean reverting, and the long-run sustainable growth rate is determined by fundamental factors like population growth, productivity improvement, and reinvestment of profits. Over very long periods, the real growth rate of corporate earnings in developed economies has been roughly in line with the real growth rate of the overall economy, around 2 to 3% per year. This is important because many investors, after a period of strong earnings growth, extrapolate that growth forward and overestimate future growth, which leads to inflated estimates of future returns. Ilmanen is careful to point out that the growth component of equity returns is often lower than investors assume, particularly when you account for the dilution that occurs as companies issue new shares, and when you recognize that much of headline earnings growth reflects cyclical upswings rather than sustainable structural improvements. The third building block is valuation change. This is the change in the price that investors are willing to pay for a given level of cash flows, and it is the most volatile and the most unpredictable component of returns. In the short run, valuation changes can dominate everything else. A market where the price-to-earnings ratio expands from 15 to 20 over a year will show extraordinary returns even if earnings are flat, simply because investors are willing to pay more per unit of earnings. Conversely, a market where the price-to-earnings ratio contracts from 20 to 15 will show terrible returns even if earnings are growing, because the derating more than offsets the earnings growth. In the long run, valuation changes tend to mean revert, meaning they go back toward their historical average levels. This mean reversion makes valuations a powerful tool for forecasting long-run returns. When assets are expensive relative to their historical norms, forward returns tend to be lower because valuations are more likely to compress than expand. When assets are cheap relative to their historical norms, forward returns tend to be higher because valuations are more likely to expand than compress. The fourth building block is currency. For investors who own assets in foreign countries, currency movements can add to or subtract from returns when measured in their home currency. A strong home currency erodes the returns from foreign investments when converted back. A weak home currency enhances them. Currency returns are extremely difficult to predict in the short run, driven by a complex mix of trade flows, capital flows, central bank policy, and investor sentiment. But over very long periods, there is compelling evidence that currencies tend to revert toward fair value based on purchasing power parity, meaning the level at which a given amount of money buys roughly the same basket of goods in different countries. Together, these four building blocks explain virtually all of the variation in long-run investment returns across different asset classes and different time periods. When Ilmanen wants to assess expected returns for any asset, he asks, what is the current yield? What is a reasonable estimate of future growth? Is the current valuation high or low relative to history? And what are the currency considerations, if relevant? This framework is elegant in its simplicity, but extraordinarily powerful in its application. Now let us take these building blocks and apply them to the most important asset classes in the world, starting with the one that most investors care about most: equities. Stocks are the engine of wealth creation for most long-term investors. Over the very long run, stocks in the United States have delivered real returns of roughly 5 to 7% per year above inflation, which is exceptional compared to almost any other liquid asset class. But that historical record comes with important caveats that every investor must understand before anchoring to those numbers. First, the historical equity premium, which is the extra return stocks have provided over safe government bonds, has been higher in the United States than in most other countries. The United States had extraordinary economic success in the 20th century, and some of that success was not predictable in advance at the start of that century. Ilmanen calls this survivorship bias. We study American stock returns partly because America was the biggest economic success story of the modern era. Countries that performed less well or that experienced catastrophic events like world wars, hyperinflation, or communist revolutions did not produce the same returns for equity investors, and in some cases, produced no returns at all, or left investors with complete losses. This means that assuming the historical U.S. equity premium will repeat in the future may be overly optimistic, because we are anchoring to a particularly successful historical period in a particularly successful country, and we cannot know whether that exceptional success will persist at the same rate. Second, much of the 20th century equity premium came from rising valuations. At the beginning of the 20th century, stocks were cheap by almost any measure. valued at low multiples of earnings, dividends, and book value. By the end of the century, stocks were expensive, valued at much higher multiples that reflected the enormous growth and confidence of that era. That expansion in valuation, from cheap to expensive, added several percentage points per year to the returns that investors received over the full period. But it cannot repeat unless valuations expand still further from already elevated levels, which would make stocks even more expensive than they already were, which is structurally unsustainable. So when you strip out the one-time valuation expansion that happened over the past century, the underlying structural return from equities, the return driven by dividends and earnings growth alone, is meaningfully lower than the headline historical number suggests. This does not mean you should not own stocks. Stocks still offer the best long-run expected return of any major liquid asset class. But it is a powerful reason to calibrate expectations carefully and not assume that the past century of American equity returns will simply repeat in the next century. The equity risk premium. At the heart of the question about equities is the concept of the equity risk premium. The equity risk premium is the extra return that investors demand for holding stocks rather than risk-free government bonds. It is the compensation for the genuine risks that equity investors bear, including the risk that the company goes bankrupt, the risk that earnings fall during recessions, the risk that the stock price declines sharply in a market downturn, and the risk that you might need to sell at a moment when prices are depressed. Ilmanen estimates the equity risk premium going forward, at a typical level of valuations, in the range of 3 to 5% per year above government bonds. This is lower than the approximately 5 to 7% historical average premium, for the reasons already discussed, but it is still large enough to justify a substantial allocation to equities in most long-term portfolios. To understand why this premium exists and whether it is likely to persist, Ilmanen examines several theoretical explanations. The simplest explanation is straightforward risk aversion. Stocks are genuinely risky. They can fall by 50% or more during severe bear markets, and if you need to sell at the worst moment, perhaps because you lost your job during a recession that coincided with a market crash, or because you had an unexpected expense during a financial crisis, the realized loss can be severe and permanently damaging to your financial position. The equity premium is the compensation for bearing that risk. A deeper explanation relates to something financial economists call consumption smoothing. In a simple economic model, investors do not just care about the return on their investments in isolation. They care about how their investment returns relate to their overall financial circumstances. Stocks tend to do badly at exactly the moments when the overall economy is doing badly, when unemployment is high, when household incomes are under pressure, and when investors feel most financially stressed. This timing is what makes stocks particularly painful to hold, because their worst losses come precisely when investors can least afford them. If stocks fell during economic booms and rose during recessions, they would serve as a wonderful hedge for investors, and the premium would be small. Because the reverse is true, investors demand substantial compensation for the timing risk of equity ownership. Another explanation is simply behavioral. Historical evidence shows that investors tend to overestimate the probability of catastrophic outcomes, like a permanent collapse of the equity market, driven by vivid memories of past crashes and the powerful emotions that loss experiences create. This leads them to demand a higher premium than pure rational risk aversion alone would justify. And because the premium has been persistently higher than simple models predict, there is clearly more than just textbook risk aversion at work. The interaction of all these factors, genuine risk, timing of bad outcomes, and behavioral overreaction to volatility and loss, has produced an equity risk premium that has persisted across multiple countries, multiple time periods, and multiple economic regimes. Ilmanen's analysis suggests it will continue to persist as long as stocks remain genuinely risky and as long as investors remain human beings with real financial needs and real emotional reactions to loss. Decomposing historical equity returns. One of the most illuminating exercises in Ilmanen's work is his careful decomposition of historical equity returns into their component parts. If you look at the long-run return from equities in the United States over the 20th century, you see a magnificent compound return of roughly 10% per year in nominal terms. But when you break this down into its building blocks, the picture becomes more nuanced. The dividend yield at the start of the 20th century was approximately 4 to 5% per year, much higher than the 1 to 2% yields that prevailed for much of the early 21st century. The real growth rate of earnings and dividends was approximately 1 to 2% per year above inflation, consistent with the underlying growth rate of the economy. The contribution of inflation to nominal returns was approximately 3% per year on average over the century. So far, that gives you roughly 8 to 10% per year in nominal terms without any valuation change. But on top of that, valuations expanded over the century, as price-to-earnings ratios moved from below 10 at the start of the century to well above 15 at the end of it. This valuation expansion added perhaps 1 to 2 percentage points per year of additional return on top of the income and growth components. Now consider what this means for the future. Today, dividend yields are much lower than they were at the start of the 20th century. The earnings growth rate is unlikely to permanently exceed the historical average, and with valuations already elevated, the valuation expansion that contributed so much to past returns is unlikely to repeat. Adding up today's lower dividend yield, a moderate growth assumption, and limited scope for further valuation expansion, the forward-looking expected return from equities in nominal terms is likely to be somewhat lower than the historical 10% per year. In real terms, after inflation, it might be somewhere in the range of 4 to 6% per year, which is still a compelling return relative to other asset classes, but is meaningfully lower than investors who simply extrapolate historical averages would assume. Government bonds. Government bonds, particularly those issued by the most credit-worthy nations, are the bedrock of conservative investing and the benchmark against which all other asset class returns are measured. For most of the 20th century, particularly in the first half, bonds were considered safe but dull, providing steady income but no particular excitement. Their appeal was primarily as a defensive anchor in portfolios, providing stability and income when equities were struggling. Then, starting in the early 1980s, something extraordinary happened. Interest rates, which had risen to historically extreme levels, driven by the severe inflation of the 1970s, began to fall, and they continued falling for nearly 4 decades. As interest rates fall, the price of existing bonds rises because those bonds were issued at higher rates and therefore look more attractive to new buyers, who bid up their prices. An investor who held long-duration government bonds from 1982 through the first decades of the 21st century made returns that rivaled the stock market over that period, with far less volatility. This was an extraordinary outcome that transformed the reputation of government bonds from conservative income investments into genuine return generators. But Ilmanen is very clear that this bull market in bonds was a one-time event, driven by the decline in inflation and interest rates from extreme highs to historically low levels. Those returns cannot repeat unless interest rates fall again from wherever they currently are to even lower levels. And they cannot fall below zero without exceptional policy intervention, which itself creates new and complex risks. If rates stay flat from a low starting level, bond investors earn approximately the current yield, which at various points in the post-financial crisis era was extremely low in nominal terms and often negative in real terms. If rates rise from low levels, bond prices fall and investors lose money in the short run, with the magnitude of the loss depending on the duration of the bonds held. A 10-year government bond with a duration of roughly 8 years will fall in price by approximately 8% for every 1% rise in yields. This is a significant capital loss that more than offsets the modest income in a rising rate environment. This made government bonds in a low-rate environment one of the most challenging asset classes for forward-looking expected returns, and investors who simply assumed that the bond bull market of the previous 4 decades would continue were making a serious error. The diversification value of government bonds. However, and this is one of the most important practical points in Ilmanen's work, there is a powerful reason why sophisticated investors continue to hold government bonds even when their expected standalone returns are low. That reason is diversification, and specifically, the tendency of government bonds to rise in price when equity markets fall sharply. This negative correlation between stocks and bonds, which is held in most developed markets during the post-1980 era, means that a portfolio containing both assets is smoother and less volatile than a portfolio containing only stocks. During the 2008 financial crisis, for example, long-term U.S. Treasury bonds delivered strong positive returns at the same time that stocks were falling by 50% or more. An investor who held a balanced portfolio of stocks and bonds suffered a much less severe drawdown than one who held only stocks and recovered to their starting wealth level much more quickly. This diversification benefit is real, valuable, and persistent, and it justifies holding government bonds even when their standalone expected return is modest. However, Ilmanen makes an important caveat. The negative correlation between stocks and bonds is not a law of nature. It is a statistical relationship that is held during a specific era, primarily the period of declining inflation from the 1980s onward. During the inflationary era of the 1970s, stocks and bonds both performed poorly together because high and rising inflation was bad for both asset classes simultaneously. In a world where inflation was rising unexpectedly and persistently, government bonds would not provide the same diversification benefit they offered in the low inflation era. This is a risk that investors must monitor carefully because the insurance value of government bonds in a portfolio depends critically on whether that negative stock-bond correlation holds in the specific economic environment of the future. Credit and corporate bonds. Corporate bonds occupy an interesting middle ground between government bonds and stocks in the risk-return spectrum. They offer more yield than government bonds, reflecting the risk that the issuer might default or have its credit downgraded, which would cause both income and capital losses. But they do not offer the same long-run growth potential as stocks, because their cash flows are capped by the contractual terms of the bond. The extra yield over government bonds is called the credit spread, and the key question for investors is whether that spread adequately compensates for the full risk of holding corporate bonds rather than risk-free government securities. Ilmanen's analysis of the historical evidence shows that investment-grade corporate bonds have delivered a modest but genuine excess return over comparable government bonds on average across history. The realized credit spread, net of actual default losses, has been positive, meaning that investors who diversified across many investment-grade corporate bonds captured a genuine credit premium over time. But the credit premium is highly variable and heavily dependent on the economic cycle. During periods of economic expansion and market confidence, credit spreads tighten, meaning investors accept lower compensation for credit risk and expected future returns from corporate bonds decline. During recessions and financial crises, credit spreads widen dramatically, sometimes by hundreds of basis points, meaning that investors who buy at those moments lock in very attractive expected returns. The practical implication is that corporate bonds are most attractive as an investment when they are least comfortable to hold during periods of economic stress and market fear. This is a pattern that repeats across many different asset classes and strategies in Ilmanen's analysis, and it reflects the fundamental truth that expected returns are highest when risk perceptions are greatest. High-yield bonds, sometimes called junk bonds, are issued by companies with lower credit quality and offer spreads that are much wider than investment-grade bonds. They have historically delivered higher total returns than investment-grade bonds, consistent with their higher risk, but they also exhibit much more volatility and experience much larger losses during recessions, because lower quality companies are more likely to default when economic conditions deteriorate. High-yield bonds tend to behave more like equities than like traditional bonds during market stress, showing high correlations with the stock market precisely when investors are most counting on their bonds to provide stability. This equity-like behavior during crises limits their diversification value and means investors should think of high-yield bonds as a hybrid asset class, somewhere between traditional fixed income and equities in terms of risk and expected return. Inflation-linked bonds. One of the most intellectually interesting asset classes that Ilmanen discusses in depth is inflation-linked bonds. These bonds, known by various names around the world, including TIPS in the United States and linkers in the United Kingdom, have a unique feature that no other mainstream financial asset can match. Their principal and interest payments are adjusted for actual inflation. If inflation is 3% in a given year, the face value of the bond increases by 3%, and the interest payment is made on the higher adjusted principal. This means that an inflation-linked bond provides a guaranteed real return, meaning a return above inflation, as long as it is held to maturity. The yield on an inflation-linked bond is therefore a real yield, expressed in inflation-adjusted terms, whereas the yield on a conventional government bond is a nominal yield that includes compensation for both a real return and expected future inflation. The difference between the nominal yield on a conventional government bond and the real yield on an inflation-linked bond is called the break-even inflation rate, because it represents the inflation rate at which you would be indifferent between the two bonds from a total return perspective. If actual inflation over the holding period turns out to be higher than the break-even rate, the inflation-linked bond outperforms. If actual inflation turns out to be lower than the break-even rate, the conventional bond outperforms. The break-even inflation rate therefore represents the market's collective forecast of future inflation, and it changes over time as inflation expectations evolve. For investors who are particularly concerned about unexpected inflation, perhaps because they have long-term liabilities that grow with inflation, like pension obligations linked to the cost of living or living expenses in retirement, inflation-linked bonds offer a form of insurance that no other liquid asset class can fully replicate. They remove inflation uncertainty from the equation, guaranteeing that the real purchasing power of the bond investment will be preserved regardless of what happens to prices in the economy. This insurance is valuable, and investors who truly need inflation protection should be willing to accept a somewhat lower expected return in exchange for it. Real assets. Beyond financial securities, Ilmanen gives significant attention to what are broadly called real assets, which include direct real estate, infrastructure, commodities, timberland, and farmland. Real assets are interesting for several reasons. They have a direct link to the physical world, which means their cash flows and values tend to rise with inflation over the long run, providing a natural hedge against the erosion of purchasing power. They often exhibit low correlations with traditional financial assets, providing genuine diversification. And they typically offer attractive income yields, particularly at certain points in the market cycle. Real estate is the most familiar real asset for most investors. Over the long run, direct real estate investment has delivered returns that are roughly comparable to equities in total, with somewhat lower volatility, partly because real estate prices are not marked to market on a daily basis in the way that publicly traded securities are. The main source of return from real estate over very long periods is the income yield, the rental income relative to the value of the property. Capital gains in real estate have historically been roughly in line with inflation over very long horizons, though there have been extended periods of above-inflation price appreciation in specific cities and markets. The critical insight about real estate, like all other asset classes in Ilmanen's framework, is that expected future returns depend heavily on the current income yield and on current valuations relative to fundamentals like replacement cost and rental income. When real estate is cheap relative to rental income, or when rental yields are high, expected future returns are attractive. When real estate is expensive relative to rental income, or when rental yields have been compressed to low levels by speculative demand, expected future returns are more modest. The painful experience of investors who bought real estate at the peak of the housing bubble in many countries before 2008 illustrates exactly this principle. Infrastructure, including toll roads, airports, water utilities, and electricity networks, is another real asset class that has grown in importance for institutional investors. Infrastructure assets tend to have regulated or contracted cash flows with inflation escalators built in, which means they provide relatively predictable, inflation-linked income over very long periods. The combination of stable inflation-linked income, long asset lives, and essential nature of the services provided makes infrastructure a compelling asset class for investors with genuinely long time horizons and liabilities that are linked to inflation. Commodities. Commodities are one of the most misunderstood asset classes in all of investing, and Ilmanen devotes considerable effort to explaining the distinction between investing in commodities and simply speculating on their prices. Gold, oil, agricultural products, copper, aluminum, and other raw materials all fall under the broad category of commodities. Many investors buy commodities with the belief that they will benefit from rising commodity prices, driven by global economic growth, population increase, or resource scarcity. But this confuses the return on commodities as physical objects with the return on commodity futures, which is what most investors actually receive when they invest through commodity funds or exchange-traded products. Ilmanen makes a crucial distinction that is often overlooked. The total return from a commodity futures investment has three distinct components. The first component is the spot return, which is the return from changes in the physical price of the underlying commodity. The second component is the roll yield, which arises from the shape of the futures curve and the cost of rolling positions forward as contracts expire. The third component is the collateral return, which is the return earned on the cash posted as collateral to support the futures position. Over the long run, the real price of most commodities, meaning the price adjusted for inflation, has been roughly flat or even slightly declining, as ongoing improvements in technology, extraction efficiency, and production methods reduce the cost of bringing commodities to market. This means the long-run spot return from most commodities, after adjusting for inflation, is approximately zero or slightly negative. The roll yield has historically been positive on average, particularly for energy commodities, during periods when current supply is constrained relative to future supply, but it is highly variable and can turn significantly negative during extended periods when futures markets are in contango, meaning that future delivery contracts are priced higher than spot contracts. During contango periods, rolling futures positions involve selling at lower prices and buying at higher prices, which creates a drag on returns. On balance, commodity futures have delivered modest positive returns over very long periods, but with very high volatility and significant uncertainty. Their primary appeal for portfolio investors is not their standalone expected return, but their inflation hedging characteristics and diversification properties. Commodities tend to rise sharply during inflationary episodes and have had low or negative correlations with both stocks and bonds over certain time horizons, making them valuable components of a portfolio designed to be robust across multiple macroeconomic scenarios. Gold deserves special mention as a commodity with unique characteristics that set it apart from industrial commodities. Gold produces no income of any kind. It pays no dividends and no interest. It has limited industrial use relative to its total above-ground supply. Yet gold has preserved its purchasing power over extraordinarily long periods, over centuries in fact, and it tends to rise sharply during periods of financial crisis, geopolitical stress, and uncertainty about the stability of fiat currencies. For investors who fear catastrophic scenarios, systemic financial collapse, hyperinflation, or severe geopolitical disruption, gold offers a form of insurance that few other assets can provide. But insurance costs money. The expected return from gold in normal economic conditions is low, or approximately zero in real terms, meaning gold merely keeps pace with inflation over long periods without generating additional real wealth. Investors who hold gold are essentially paying an insurance premium in the form of foregone returns on more productive assets. Whether that insurance is worth the cost depends entirely on the individual investor's specific circumstances, risk tolerance, and assessment of tail risks. Currencies as an asset class. Currency is an aspect of investing that is often treated as an afterthought or a passive byproduct of international investing, but Ilmanen argues that currencies deserve to be treated as a genuine asset class with their own expected return drivers and their own distinct risk characteristics. Over the very long run, currencies tend to move toward purchasing power parity, the exchange rate level at which similar goods cost roughly similar amounts in different countries after currency conversion. But this convergence can take decades, sometimes generations, and in the meantime, currency movements can dramatically help or hurt international investment returns when measured in an investor's home currency. In the short run, currency movements are driven by a complex mixture of interest rate differentials, current account balances, capital flows, central bank intervention, political developments, and shifting risk sentiment, making them very difficult to predict. One of the most well-documented and persistent patterns in currency markets is the carry trade. In currency carry, investors borrow in currencies with low interest rates, typically countries with slow economic growth or deflationary pressures, and invest in currencies with high interest rates, typically countries with stronger growth and higher inflation. The positive interest rate differential generates income as long as the exchange rate stays relatively stable. Historically, this strategy has earned a positive return on average over long periods because high interest rate currencies do not depreciate as much as the interest rate differential alone would imply, based on a simple model where currency returns offset interest rate differences exactly. However, the currency carry trade is subject to occasional sudden and severe crashes, typically coinciding with broader financial market stress. When global risk appetite deteriorates and investors rush towards safety, they tend to unwind, carry trades simultaneously, causing the high-yielding currencies to fall sharply and the low-yielding safe haven currencies, like the Japanese yen and the Swiss franc, to spike higher. These carry trade unwinds can produce losses in a matter of days that dwarf months or years of accumulated carry income. This pattern illustrates one of the most important themes that runs through Ilmanen's entire framework, the idea that many sources of excess return in financial markets are best understood as compensation for bearing tail risk rather than as truly riskless alpha. The carry premium exists because someone must bear the risk of sudden, violent reversals when risk sentiment changes, and the premium is the payment for that willingness to remain exposed to tail risk during normal times. Alternative risk premia. Beyond traditional asset classes, Ilmanen devotes some of the most intellectually rich sections of his analysis to what are now commonly called alternative risk premia, or factor-based strategies. These are systematic, rules-based sources of return that have been identified through decades of academic research and practical observation, and that can be harvested through disciplined investment approaches in liquid markets. The most important and well-documented alternative risk premia are value, momentum, carry, and liquidity, though Ilmanen also discusses several others, including quality, low volatility, and various term and credit premia in fixed income markets. Each of these factors has been observed across multiple asset classes, including equities, bonds, commodities, and currencies, which provides strong evidence that they reflect something fundamental about financial markets rather than being artifacts of data mining in a single asset class. Each of them has delivered positive returns over very long historical periods, but each also comes with real risks and requires genuine patience and discipline to capture successfully. Value investing in depth. Value investing is perhaps the oldest documented investment strategy in the world, with roots going back at least to Benjamin Graham and David Dodd's foundational work in the 1930s. The core idea is elegant in its simplicity. Buy assets that are cheap relative to their fundamental value, and avoid or sell assets that are expensive relative to their fundamental value. Over time, prices should converge toward fundamental value, and the patient value investor who bought cheap should profit from that convergence. The challenge, of course, lies in identifying what fundamental value actually is, and in maintaining the patience to hold cheap assets through potentially extended periods before the convergence occurs. In equity markets, value is typically measured by comparing the current price of a stock to various measures of its fundamental worth, including its earnings, its book value, its cash flows, or its dividends. Stocks trading at low multiples of these measures are value stocks. Stocks trading at high multiples are growth stocks or glamour stocks. The empirical evidence for the value premium in equities is among the most robust findings in all of financial research. Value stocks have outperformed growth stocks over long historical periods in virtually every major stock market in the world that has been studied. This premium was formally documented and popularized by Eugene Fama and Kenneth French in their landmark research of the early 1990s, and it has been extensively studied, debated, and replicated in the decades since. Why does the value premium exist, and why does it persist despite being widely known? Ilmanen presents and evaluates both the risk-based and behavioral explanations for the value premium with characteristic thoroughness. The risk-based explanation holds that value stocks, by definition, are companies that the market is pricing at low multiples for a reason. They are often companies that are going through periods of difficulty, uncertainty, or structural challenge. Their futures are more uncertain than those of the glamorous growth companies that trade at premium valuations. Holding a diversified portfolio of such companies requires genuine conviction, tolerance for continued bad news, and willingness to accept short-term underperformance while waiting for things to improve. The premium is the market's way of compensating investors for bearing that uncertainty and discomfort. The behavioral explanation holds that investors are systematically too pessimistic about the future prospects of currently struggling companies and too optimistic about the future prospects of currently successful, growing companies. They extrapolate recent trends too aggressively, assuming that companies doing badly today will continue to deteriorate and that companies doing well today will continue to grow at their recent pace. The reality, supported by extensive evidence, is that business performance tends to mean revert. Companies that have done poorly tend to recover through management changes, restructuring, or simply the natural competitive dynamics of markets. Companies that have done well eventually face new competition, saturation of their markets, or the simple mathematical reality that high growth rates cannot be sustained indefinitely. This mean reversion creates the opportunity for the patient investor who is willing to buy the out-of-favor, cheap stocks and wait for the inevitable recovery. Ilmanen concludes that both explanations contain substantial truth. The value premium is real and persistent, but it is not free money. It requires patience, sometimes years, or even a decade of waiting. The psychological fortitude to hold cheap-looking assets through periods of further decline, and the discipline not to abandon the strategy at exactly the moment when the pain is greatest and the temptation to switch to a better-performing approach is strongest. Value investing is also complicated by the fact that cheap stocks are sometimes cheap for very good reasons. Not every company trading at a low price to earnings ratio is an undervalued opportunity. Some are value traps, meaning companies with genuine structural problems that will never recover, and where the low valuation reflects accurate, rather than excessively pessimistic assessment. Distinguishing undervalued companies from value traps requires judgment and qualitative analysis beyond simple quantitative screening, which is one reason why even a systematic value approach requires careful implementation. Momentum in depth. Momentum is in many ways the conceptual opposite of value, and the fact that both strategies have historically delivered positive returns is one of the most provocative puzzles in financial economics. Where value says that past losers will become future winners as prices revert toward fundamental value, momentum says that recent winners will continue to win and recent losers will continue to lose, at least for a period of several months to a year. The momentum phenomenon was formally documented in Equities by Narasimhan Jagadish and Sheridan Titman in their celebrated 1993 research paper, which showed that stocks with strong returns over the past 3 to 12 months tended to outperform over the subsequent 3 to 12 months, while stocks with poor recent returns tended to continue underperforming. This finding has since been replicated across virtually every equity market in the world and across many other asset classes, including fixed income, currencies, and commodities. The returns to momentum strategies have historically been both large and persistent, making momentum one of the most powerful of all documented risk premia. The explanations for momentum are almost entirely behavioral. Investors tend to underreact initially to new information, anchoring to previous beliefs and being slow to update their views when evidence accumulates. As a result, when a company reports better than expected earnings, or when a macroeconomic trend becomes established, prices adjust gradually rather than instantaneously, creating persistent trends as the market slowly incorporates the full implications of the new information. Additionally, investor herding behavior and feedback trading, where rising prices attract more buyers who further push prices higher, can amplify initial trends and extend them beyond what fundamentals alone would justify. Eventually, the trend will end, either because the fundamentals that drove it have been fully priced in, or because valuations have become so extreme that the mean reversion forces identified by value investors overwhelm the momentum. This creates the interesting interaction between momentum and value noted earlier. In the short to medium term, of months to a year or so, momentum tends to be the dominant force. Over longer time horizons of years to a decade, value tends to be dominant. Sophisticated investors who understand both phenomena can use them in a complementary way, with momentum providing timing signals for entering and exiting positions, and value providing the longer-run strategic framework for which assets are fundamentally cheap or expensive. The dark side of momentum, however, is significant enough that Ilmanen devotes considerable attention to it. Momentum strategies tend to suffer sudden, violent, and extremely painful reversals, particularly around major market turning points. When a bear market suddenly and sharply reverses into a bull market, as happened in March 2009 after the depths of the financial crisis, momentum strategies experience what researchers call momentum crashes. At such turning points, the momentum strategy holds exactly the wrong positions: long the recent winners, which are about to become losers, and short the recent losers, which are about to become the biggest winners. The resulting losses can be enormous and can erase months or years of accumulated gains in just a few weeks. These momentum crashes are not random. They tend to happen during periods of extremely high market volatility following a severe market decline, and they tend to be larger when the preceding momentum returns were larger, suggesting that the strategy was more crowded and more vulnerable to reversal. For investors implementing momentum strategies, position sizing, risk management, and the ability to distinguish genuine trend reversals from temporary noise are essential tools for managing this tail risk. Carry in depth. The carry strategy is one of the most versatile and widely applied of all alternative risk premia, and Ilmanen's treatment of it is among the most comprehensive available. The fundamental idea of carry is earning the income or carry from holding a higher-yielding asset while being hedged against certain forms of underlying price risk. In currency markets, as discussed earlier, carry means borrowing in low-yielding currencies and investing in high-yielding currencies. In bond markets, carry means being long at steep parts of the yield curve, where longer-dated bonds offer significantly higher yields than shorter-dated bonds, and neutral or short at flat parts. The carry in this case comes from the slope of the yield curve, the difference in yield between bonds of different maturities. In commodity markets, carry relates to the shape of the futures curve. When the futures curve is in backwardation, meaning near-term futures contracts are priced higher than longer-dated ones, a commodity investor earns a positive roll yield from holding futures positions, because the futures price will converge upward toward the higher spot price as the contract approaches delivery. In equity markets, carry relates to the dividend yield and earnings yield, with higher-yielding stocks offering more carry income than lower-yielding growth stocks. The carry premium across all these markets reflects a fundamental asymmetry in investor preferences and risk tolerance. Investors generally prefer certainty of income to uncertainty, and assets that offer higher current income must therefore offer higher total expected returns to compensate for the risk that the higher income is not sustainable or that the capital value will decline. Historically, carry strategies have delivered consistent positive returns across all major asset classes over long periods. But Ilmanen's analysis is emphatic on one crucial point. The carry premium is not compensation for bearing no risk. It is specifically compensation for bearing crash risk, for the willingness to hold positions that will suffer severe losses during episodes of sudden, broad-based risk aversion. The Japanese yen carry trade provides the clearest illustration. For years, before the 2008 financial crisis, investors borrowed in low-rate Japanese yen and invested in higher-yielding currencies around the world. The income was steady, and the positions seemed to work flawlessly. When the crisis hit, the resulting scramble for safe assets caused the yen to spike dramatically higher, and the carry trade reversed violently, producing losses that wiped out years of accumulated income in a matter of weeks. This pattern, steady income in calm conditions, followed by severe losses during crises, is the signature of a strategy that is essentially selling insurance. The carry income is the premium collected by the insurance seller. The crash losses are the insurance claim that the seller must pay. Understanding this insurance selling nature of carry strategies is essential for sizing them appropriately and for maintaining realistic expectations about when they will fail. Liquidity premium in depth. The liquidity premium is compensation for holding assets that cannot be sold quickly at a fair price without significant cost or market impact. Every investor has experienced some version of this phenomenon. The difference between being able to sell a widely traded stock instantly at the quoted price and needing to sell a small cap stock or a corporate bond where the bid-ask spread is wide and where a large sell order might move the price significantly against you. Ilmanen documents that across virtually every asset class, less liquid assets have historically delivered higher returns than more liquid ones, after accounting for the higher trading costs and the occasional difficulty of trading at all. The liquidity premium is strongest in the most illiquid parts of the market. Private equity, which involves investing in companies that are not publicly traded and whose shares cannot be sold without significant time and effort, has historically delivered returns above public equity markets. Private credit, which involves making loans to companies outside of public bond markets, has delivered returns above public high-yield bonds. Unlisted real estate has delivered returns above listed REITs. These premiums reflect the genuine risks that illiquid investors bear. They cannot exit their positions when market conditions deteriorate. They may face prolonged holding periods, even if they identify mistakes. They must accept that the true market value of their holdings is uncertain and estimated rather than observable. And they face the risk that in a genuine crisis, the liquidity of even supposedly liquid assets may evaporate, leaving them unable to rebalance or raise cash precisely when they most need to do so. For investors who truly have long-time horizons and stable capital, who genuinely will not be forced to sell during market dislocations, the liquidity premium is one of the most attractive and reliable sources of incremental return available. The largest pension funds, endowments, and sovereign wealth funds in the world have recognized this and have allocated substantial portions of their portfolios to illiquid alternatives precisely to harvest the liquidity premium. But Ilmanen is careful to warn against overconfidence about the ability to tolerate illiquidity. Many investors discover too late that their time horizon was shorter than they thought, that their funding was less stable than they assumed, or that the psychological discomfort of holding illiquid assets through a crisis was greater than they anticipated. The smooth reported returns of private equity or private real estate portfolios, which are only valued quarterly or annually, can create a false sense of security that evaporates when the underlying reality becomes clear in the next vintage fund cycle. Investors should be brutally honest with themselves about whether they truly have the capital stability and psychological fortitude to hold illiquid assets through their full investment cycles before committing to large illiquidity premiums. Macroeconomic regimes and asset returns. One of the richest and most practically useful sections of Ilmanen's framework is his analysis of how different macroeconomic regimes affect the returns of different asset classes. Understanding these relationships allows investors to think probabilistically about the scenarios in which their portfolios will perform well or poorly, and to make deliberate decisions about the degree to which they want to hedge against different economic outcomes. Ilmanen's analysis identifies two key macroeconomic variables that matter most for asset class returns across history. The first is the growth cycle, whether the economy is expanding above its long-run trend rate or contracting below it. The second is the inflation cycle, whether inflation is rising or elevated above normal levels or falling or low. Combining these two variables gives four distinct macroeconomic regimes. The first regime is rising growth combined with falling inflation. This is generally the most benign environment for financial assets, particularly equities. Corporate earnings grow, central banks have room to be accommodative or are cutting rates, and investor sentiment is positive. Both stocks and bonds tend to perform well in this environment. The second regime is falling growth combined with falling inflation. This is a recessionary environment with deflationary pressure. Stocks typically perform poorly as earnings fall and uncertainty rises. Government bonds typically perform very well as investors seek safety and central banks cut rates aggressively. Cash also becomes relatively attractive as its real value is preserved or enhanced by deflation. The third regime is rising growth combined with rising inflation. This is an inflationary boom environment. Real assets like commodities, real estate, and inflation-linked bonds typically perform well. Nominal bonds struggle as inflation erodes their real value. Equities give mixed results, with some sectors benefiting from pricing power, while others suffer from rising input costs. The fourth regime is falling growth combined with rising inflation, which economists call stagflation. This was the defining economic challenge of the 1970s in many developed countries. Stagflation is genuinely the worst environment for most financial assets. Both stocks and bonds struggle because recession hurts corporate earnings, while inflation erodes the real value of fixed income instruments simultaneously. Real assets and commodities are the relative winners in stagflation, but even their nominal returns may not keep pace with very high inflation. The critical implication for portfolio construction is that the traditional 60% equity and 40% bond portfolio is well positioned for two of these four regimes, the falling inflation environments, but is poorly positioned for the two inflationary scenarios, particularly stagflation. A portfolio that also includes real assets, commodities, and inflation-linked bonds is better positioned to withstand inflationary surprises, though it sacrifices some expected return in the more common low-inflation environments. This framework for thinking about macroeconomic scenarios and portfolio resilience was a significant intellectual contribution of Ilmanen's work and directly influenced the development of risk parity and all-weather portfolio strategies at major institutional investors. Behavioral finance and the sources of premiums. Throughout his analysis, Ilmanen wrestles with a fundamental question that every thoughtful investor must confront. If the risk premiums he documents are real and persistent, and if they are well known to professional investors, why do they not simply get arbitraged away? Why do value stocks still outperform growth stocks when everyone knows about the value premium? Why does the carry trade still work when every hedge fund knows about it? Why do momentum strategies still earn positive returns when academic journals have been publishing the research for decades? The answer involves both behavioral and structural explanations, and understanding both is essential for judging whether these premiums are likely to persist. The behavioral explanations relate to persistent and systematic patterns in how investors process information and make decisions. These patterns do not go away just because academics document them, because they are deeply embedded in human psychology and in the structure of professional investment management. Overconfidence leads investors to trade too much and to hold concentrated positions based on their own views. Loss aversion causes them to sell declining assets at exactly the wrong moment and to hold winning assets past the point where expected returns have become unattractive. Herding causes prices to overshoot fair value in both directions as waves of optimism and pessimism sweep through markets. Anchoring causes investors to be slow to revise their views when new information contradicts their prior beliefs. These tendencies are deeply human, and they are reinforced by the structure of professional investment management, where career risk leads portfolio managers to herd toward consensus, where short-term performance is measured and rewarded quarterly or annually, and where clients will withdraw funds after periods of underperformance, regardless of long-run expected returns. The structural explanations relate to the real constraints and frictions that prevent purely rational arbitrage from eliminating all mispricings. Investors face position limits, leverage constraints, and funding risks that prevent them from exploiting identified mispricings without limit. Some premiums represent compensation for genuine risks that rational investors must bear, and those risks do not disappear simply because they are understood. And the information processing required to identify and exploit mispricings takes time, skill, and capital that not all investors possess. Together, these behavioral and structural factors create a world in which genuine mispricings and risk premiums persist over time, even in the presence of sophisticated investors who know about them and try to exploit them. This is the foundation of Ilmanen's belief that the risk premiums he documents will continue to be available to patient, disciplined investors in the future, even though they will not be free money and will require genuine commitment to harvest successfully. Tail risk and the management of catastrophic losses. No framework for thinking about investment returns is complete without a serious treatment of tail risks, the low probability, high impact events that can cause catastrophic and permanent damage to investment portfolios. The 20th and early 21st centuries provided a sobering catalog of such events. The Great Crash of 1929 and the subsequent Great Depression wiped out enormous wealth and shook confidence in financial markets for a generation. The collapse of the Japanese stock market and real estate bubble, beginning in 1989, resulted in more than 2 decades of stagnation in asset prices, devastating investors who had assumed that rising prices reflected economic fundamentals rather than speculative excess. The Asian financial crisis of 1997 and the Russian default of 1998, which triggered the collapse of long-term capital management, demonstrated how quickly seemingly well-diversified, quantitatively sophisticated portfolios could implode when assumptions about correlations and liquidity proved incorrect under stress. The dot-com bust of 2000 to 2002 showed that even widely diversified equity portfolios could lose 50% or more of their value when a broad asset class becomes fundamentally overvalued. And the 2008 global financial crisis was the most dramatic reminder of all that complexity, leverage, and interconnectedness can transform what appear to be manageable risks into systemic catastrophes. Ilmanen's analysis of these events reveals a consistent pattern. Markets are most dangerous not when everyone is afraid, but when everyone is calm and confident. In the years before each of the crises listed above, markets were characterized by low volatility, tight credit spreads, high valuations, elevated use of leverage, and the widespread belief that risk had been permanently reduced or successfully distributed through financial innovation. This collective complacency about risk is self-defeating. Low perceived risk leads investors to take on more actual risk, to use more leverage, and to crowd into similar positions based on similar models and similar reasoning. This crowding is invisible in the price data until something breaks the equilibrium, and when it breaks, the forced simultaneous unwinding of crowded positions amplifies the initial shock dramatically. Understanding this dynamic suggests a contrarian approach to thinking about portfolio risk. Be most cautious when markets are most calm. Reduce leverage and crowded exposures when volatility is very low and credit spreads are very tight. Be most willing to accept risk when markets are most fearful and when dislocations are creating genuinely attractive expected returns. This is simple to say and extraordinarily difficult to do in practice, because it requires acting against the powerful tide of market sentiment and against the social pressure that comes from diverging from consensus precisely at moments when consensus feels most certain. But it is one of the most reliably value-adding orientations an investor can maintain over the long run. The role of leverage. Leverage, meaning borrowing to invest more than your own capital, amplifies both returns and losses. It is a powerful tool that can enhance expected returns, but it is also a source of catastrophic risk if used without careful attention to the scenarios in which it can go wrong. Ilmanen discusses leverage in several contexts, including risk parity strategies that use leverage to increase bond allocations, hedge fund strategies that use leverage to amplify the returns of small but consistent premiums, and the implicit leverage embedded in certain structured products and derivatives. The key insight about leverage is that it introduces funding risk, the possibility that you will be forced to reduce positions at the worst possible moment, not because you have made a strategic decision to reduce risk, but because your lenders demand repayment of the borrowed capital. This is why leverage is particularly dangerous when combined with illiquid assets or when used at the full extent of what is technically possible. An investor who uses leverage up to the maximum allowed by their funding sources has no buffer against adverse market moves. When prices decline, the lender may demand additional collateral or repayment of the loan. If the investor cannot provide it from other sources, they must sell assets at depressed prices, locking in losses that would have been unrealized if they had simply held through the decline. This forced selling at the worst moment is the mechanism by which moderate leverage can turn manageable losses into catastrophic ones. Prudent use of leverage involves maintaining significant buffer below the maximum technically available, ensuring that funding is stable and long-term rather than short-term and callable, and sizing leveraged positions conservatively enough that even a severe adverse market move would not trigger forced selling. The importance of investment horizon. Throughout Ilmanen's framework, investment horizon plays a crucial role in determining which strategies are appropriate and what level of risk is warranted. The time horizon of an investment is not simply a matter of personal preference or convenience. It determines which risk premia are accessible, how much liquidity risk can be tolerated, how much short-term volatility is tolerable in pursuit of long-run returns, and how actively the portfolio should be managed. Short-term investors, those with horizons of less than 2 to 3 years, face a fundamentally different investment problem than long-term investors. Short-term investors cannot ignore short-term volatility because a large drawdown early in the investment period may require them to liquidate at a loss. Long-term investors can in principle ride through drawdowns and recover as long as they have the capital stability to remain invested. For this reason, the risk capacity of a long-term investor is genuinely greater than that of a short-term investor, and the appropriateness of taking on equity risk, illiquidity risk, and other forms of return-generating risk is greater for those with longer horizons. Pension funds, with liabilities stretching decades into the future, endowments with effectively infinite time horizons, and individual investors who are saving for retirement decades away can all legitimately take on more risk than investors who will need their capital in the near term. However, there is an important behavioral caveat. The effective investment horizon of most investors is shorter than their stated horizon because periods of severe market stress create psychological and financial pressures that cause even long-term investors to shorten their horizons. When a portfolio has lost 40% of its value during a crisis, even an investor who intellectually knows that the long-term expected return is attractive may face calls from trustees, beneficiaries, or their own emotional reactions that force premature liquidation. Building a portfolio that is genuinely matched to the true effective horizon, including accounting for behavioral pressures during market stress, requires conservative assumptions about how much volatility and loss the investor can genuinely tolerate without deviating from the long-term plan. The practice of strategic asset allocation. Bringing all of these concepts together into a coherent investment framework requires a disciplined approach to strategic asset allocation, meaning the long-run policy portfolio that reflects the investor's objectives, constraints, and best estimates of risk and expected return across asset classes. Ilmanen's approach to strategic asset allocation begins with a clear understanding of the investor's investment objectives. What is the purpose of the portfolio? What are the liabilities or spending needs the portfolio must finance? What is the realistic investment horizon? What is the genuine tolerance for short-term losses, taking into account behavioral realities and not just stated preferences? What are the regulatory, liquidity, or other constraints that limit the investable universe? Once these objectives and constraints are clear, the investor can form estimates of expected returns, volatilities, and correlations for each asset class under consideration, and use these inputs to construct a diversified portfolio that gives the best possible chance of meeting the investment objectives. The portfolio construction process should be informed by both long-run historical evidence and current conditions. Long-run historical evidence establishes the baseline risk-return relationships and correlations that should characterize different asset classes over full economic cycles. Current conditions, particularly current valuations and current yield levels, provide information about how expected returns today may differ from long-run averages. When stocks are expensive relative to history, the expected return from stocks should be reduced below the long-run average. When government bonds offer very low yields, the expected return from bonds should similarly be reduced. This current conditions adjustment is one of the most important and most frequently neglected aspects of strategic asset allocation. Investors who simply use long-run historical averages as their expected return assumptions, without adjusting for current conditions, are implicitly ignoring one of the most powerful predictors of future returns that exists. Regular rebalancing is another essential component of effective strategic asset allocation. Because different asset classes grow at different rates, any fixed-weight portfolio will drift over time from its intended allocations. The asset classes that have performed best will become overweight relative to their target, while those that have performed worst will become underweight. Rebalancing involves trimming the overweight assets and adding to the underweight ones, bringing the portfolio back to its intended allocation. This mechanical process of selling what has risen and buying what has fallen is a systematic implementation of the value principle in a portfolio context. It does not require predicting which assets will outperform, only the discipline to maintain the intended portfolio structure, regardless of recent performance. Research shows that disciplined rebalancing adds modest but reliable value over time, primarily by preventing the portfolio from becoming excessively concentrated in whatever has recently performed best and buying more of whatever has recently been left behind. Evaluating active management. No treatment of expected returns would be complete without addressing the question of active management, the claim made by many fund managers that they can consistently identify investments that will outperform the market after fees. Ilmanen approaches this question with characteristic rigor and honesty. The evidence on active management is not encouraging for most active managers. Across most asset classes and most time periods, the majority of actively managed funds have underperformed comparable passive index funds after accounting for fees and transaction costs. This finding is robust and has been replicated across equity markets, bond markets, and most alternative asset classes around the world. The reason is not that active managers lack skill. Many active managers are highly intelligent, well-informed, and genuinely skilled at identifying investment opportunities. The problem is that in aggregate, active managers are the market. Their collective holdings constitute the market portfolio. For every active manager who overweights a stock and profits from its outperformance, another active manager underweights it and suffers underperformance. When you aggregate all active managers, the average active manager before fees earns the market return. After the fees that active managers charge, the average active manager earns below the market return. This is a mathematical identity, not an empirical finding. For active management to add value in aggregate, the market return itself would have to be generated from somewhere, and it is. There are certain skill-based edges that some managers possess, particularly in less efficient markets, like small-cap stocks, emerging markets, and illiquid credit, where information advantages and analytical work are more likely to generate genuine alpha. And the alternative risk premia that Ilmanen documents, the systematic harvesting of value, momentum, carry, and liquidity, represent genuine factor-based alpha when implemented at low cost relative to pure passive approaches. But for most investors, evaluating most active managers, the evidence strongly suggests that the fees charged are unlikely to be justified by the net of fee alpha delivered, and that a low-cost, diversified, factor-aware approach to portfolio construction will outperform the average active fund over any meaningful investment horizon. The most honest thing Ilmanen says about active management is simply that the burden of proof lies with the active manager to demonstrate genuine, persistent, net of fee alpha, and that this burden is high enough that most managers who claim to clear it, in fact, do not. Understanding risk. Risk is perhaps the most widely discussed and least consistently defined concept in all of investing. Different investors mean different things when they say risk. Some mean the probability of losing money over a specific period. Some mean the volatility of returns from month to month. Some mean the risk of permanently losing capital. Some mean the risk of not achieving a required rate of return. Ilmanen is careful to distinguish between different forms of risk and to identify which ones actually matter for investor welfare. Volatility, meaning the month-to-month or year-to-year fluctuation in portfolio value, is the most commonly measured form of risk and the one that dominates most academic portfolio theory. But volatility is not the same as the risk of permanent loss. A volatile asset that recovers its value over time has not caused permanent harm to a long-term investor who held through the volatility. The risk that truly matters to most investors is the risk of a permanent impairment of capital, meaning a loss from which the portfolio cannot recover within the relevant investment horizon. This permanent impairment can come from several sources. It can come from concentration in a single security or a small number of securities that fail. It can come from leverage that triggers forced liquidation during a temporary market decline. It can come from catastrophic macroeconomic events like hyperinflation, war, or depression that destroy the real value of a whole asset class. Or it can come from behavioral mistakes, panic selling during downturns, abandoning a sound strategy at the worst moment, and failing to reinvest during recoveries. Understanding these different sources of risk and managing them appropriately is far more important for long-term investment outcomes than optimizing portfolio volatility in a spreadsheet. The importance of process. One of the most practically valuable insights that emerges from Ilmanen's framework is that the investment process matters as much as any specific investment insight. A sound, disciplined process will produce better outcomes over time than even the most brilliant set of insights applied inconsistently or without discipline. The investment process needs to begin with clearly articulated beliefs about what drives returns, what risks exist, and what time horizons matter. These beliefs should be grounded in evidence, but held with appropriate humility, recognizing that they may be wrong and may need revision as new evidence accumulates. The process needs to include explicit policies for how the portfolio will be constructed, how positions will be sized, when they will be rebalanced, and what conditions would trigger a change in the strategic allocation. Having these policies written down in advance, rather than decided on the fly in response to market events, is essential for preventing the emotional and behavioral biases that lead to poor decisions from overriding the rational analysis. The process also needs to include a commitment to evaluating and learning from outcomes over time. Performance attribution, understanding which decisions added value and which detracted, is a crucial feedback mechanism that helps investors refine their process and improve their decision-making over time. And the process needs to include explicit humility about uncertainty. Even the most carefully constructed expected return estimates are subject to error, and the future will always contain surprises. A sound investment process builds in robustness to a range of outcomes rather than optimizing for a single scenario. Long-run perspectives on global investing. Ilmanen's work is unusual among investment books in the breadth and depth of its global perspective. He draws on data from markets around the world, across different centuries in some cases, to identify patterns that are genuinely robust rather than artifacts of the particular history of any single market. This global and historical perspective produces several important insights that domestic-focused investors often miss. The first is that the United States equity market, while remarkable in its long-run performance, has been an exceptional case among global markets rather than the norm. Most national equity markets have experienced at least one episode of catastrophic loss in the past century, whether from war, revolution, extreme inflation, or financial collapse. Investors who are fully concentrated in those markets suffered permanent losses of capital from which they could not recover within a normal human lifetime. True diversification across countries and regions is not just an academic nicety. It is a genuine form of tail risk management against the possibility that any single country could experience a severe, prolonged dislocation. The second insight is that the cross-country evidence on risk premiums is broadly supportive of the framework developed from U.S. data. Value, momentum, and carry premia have been documented across equity markets in Europe, Asia, and emerging markets. They appear in bond markets globally. They appear in currency and commodity markets. This cross-sectional robustness provides much stronger evidence that these are genuine, persistent features of financial markets than could be obtained from any single country or asset class. The third insight is that macroeconomic diversity across countries creates diversification opportunities. Different countries are at different points in their economic cycles at any given time. Different countries have different inflation dynamics, different monetary policy regimes, and different demographic profiles. Building a genuinely global portfolio that captures this diversity is more robust to single-country economic shocks than a purely domestic portfolio. Practical implications for different types of investors. Ilmanen's framework applies to all types of investors, but the specific implications differ depending on the type of investor and their circumstances. For individual investors managing their own savings and retirement portfolios, the key implications are relatively straightforward. Maintain a genuinely diversified portfolio across asset classes, including equities, bonds, and real assets. Hold a significant allocation to equities for the long-run equity premium, sized appropriately for the investment horizon and risk tolerance. Keep costs low by using index funds and exchange-traded funds rather than high-cost active funds wherever possible. Rebalance regularly and mechanically, fighting the instinct to buy more of what has risen. Set realistic expectations for future returns, particularly in a world where starting valuations are elevated, and save accordingly. For institutional investors managing pension funds, endowments, or sovereign wealth funds, the framework is richer and more complex. These investors have the scale to access a wider range of asset classes and strategies, including private equity, private credit, infrastructure, and systematic factor-based strategies. They have the long investment horizons to access the liquidity premium through illiquid alternatives, and they have the governance structures, in principle, to maintain disciplined long-term strategies through periods of market stress. The key implication for institutional investors is to think explicitly about the full range of risk premia available, to seek genuine diversification across factor exposures and asset classes, and to align the portfolio structure with the specific liabilities and objectives of the institution rather than simply mimicking peers or following conventional wisdom. For professional investors at hedge funds, investment banks, or asset management firms, the framework provides a principled basis for identifying and evaluating potential investment opportunities. Is the expected return being offered adequate compensation for the risks being taken? Are the risks being correctly identified and measured? Is the strategy robust to the specific macroeconomic scenarios where it is most likely to fail? These questions, grounded in the framework of expected returns and risk premia, provide a more rigorous basis for investment decisions than intuition or short-term performance alone. Why realistic expectations matter. The investment profession has a powerful structural tendency toward optimism. Asset managers want to attract capital by showing attractive projected returns. Pension funds want to show that they can meet their obligations without requiring additional contributions from sponsors. Financial advisors want to retain clients by presenting scenarios where their financial goals are achievable. All of these incentives push toward presenting investors with more optimistic return projections than a careful, evidence-based analysis would support. The consequences of this systematic optimism are serious and far-reaching. When pension funds assume they will earn 8% per year from their investments, but the realistic expected return is 5 or 6% per year, they are significantly underfunding their pension obligations. This will eventually require either higher contributions from sponsors, reduced benefits to pensioners, or, in the worst cases, insolvency. When individual investors plan their retirements based on the expectation that their portfolios will grow at 10% per year, but earn 5 or 6% per year instead, they will retire with substantially less wealth than they planned for, requiring either significantly reduced spending in retirement or continued working beyond the intended retirement age. The damage from over-optimistic return assumptions is not limited to disappointed expectations. When investors are planning on higher returns than they are likely to receive, they are also underestimating the risk they are taking. They may be holding more equity risk than they can genuinely tolerate, confident in projected returns that will not materialize. They may be using leverage they cannot safely sustain. They may be relying on compound returns that will not compound at the assumed rate. Ilmanen's insistence on realistic, carefully estimated expected returns is therefore not just intellectual honesty. It is a practical service to investors and to the financial system. Plans based on realistic expectations are more likely to be sustainable, more likely to be achievable, and less likely to produce the kind of systemic disappointment that occurs when an entire generation of pension savers discovers that the promised returns were never there. Putting it all together. After this comprehensive journey through the building blocks of returns, the major asset classes, the alternative risk premia, the behavioral drivers of market dynamics, and the practical implications for portfolio construction, let us step back and identify the key insights that a serious investor should carry forward. The first insight is that expected returns are not fixed. They vary over time with valuations, yields, and macroeconomic conditions, and investors who ignore current conditions in favor of simple historical extrapolation are making a systematic error. The second insight is that every investment return can be decomposed into observable building blocks: yield, growth, and valuation change, and that current yield is the most reliable component, while valuation change is the most unpredictable. The third insight is that the equity risk premium is real and persistent, but is best estimated at somewhere between 3 and 5% above government bonds in forward-looking terms, lower than simple historical extrapolation would suggest. The fourth insight is that genuine diversification across multiple asset classes, multiple economic regimes, and multiple risk premia is one of the most powerful tools available to any investor, and that most portfolios are less truly diversified than they appear. The fifth insight is that alternative risk premia, including value, momentum, carry, and liquidity, offer genuine return potential and diversification benefits, but each comes with specific risks, including the universal tendency to suffer during periods of sudden, broad market stress. The sixth insight is that behavioral biases, including overconfidence, loss aversion, herding, and extrapolation, systematically lead most investors to make poor decisions, and that building a disciplined, evidence-based investment process that counteracts these biases is among the most valuable things any investor can do. The seventh insight is that leverage, while a powerful tool for enhancing returns, introduces funding risk that can turn manageable losses into catastrophic ones and must be used conservatively and thoughtfully. The eighth insight is that investment costs matter enormously, particularly in a world of lower expected returns, and that the discipline of minimizing fees, taxes, and transaction costs is one of the most reliable sources of incremental investment value available. The ninth insight is that the investment process matters as much as investment insight, and that a consistent, disciplined, evidence-based process with clear policies and regular review will produce better long-run outcomes than even the most brilliant insights applied inconsistently. The 10th and final insight is that investing requires genuine patience, the willingness to hold carefully constructed, well-diversified portfolios through periods of short-term underperformance, the discipline to maintain a long-run strategy through market turmoil, and the humility to revise estimates when new evidence emerges without abandoning the underlying framework. Why this work endures. Antti Ilmanen produced his major work in 2011 in the wake of one of the most devastating financial crises the modern world had ever experienced. The timing was appropriate. The crisis had exposed the failures of overconfident quantitative models, the dangers of uncontrolled leverage, the illusion of liquidity that vanished precisely when most needed, and the inadequacy of superficial diversification when correlations converged during the storm. It was a moment that demanded exactly what Ilmanen delivered: a comprehensive, rigorous, intellectually honest reassessment of how serious investors should think about expected returns across every major asset class and strategy. The framework he built does not age because it does not depend on any particular set of economic or market conditions. It provides tools for thinking about expected returns that apply in any environment, tools that tell you what to expect from an asset given its current yield and valuation, what risks you are taking on with each investment decision, and how to build a portfolio that is robust to the inevitable uncertainty of the future. The specific numbers change as valuations and yields evolve. The specific instruments available continue to develop as financial markets innovate. But the underlying framework, grounded in economic first principles and decades of empirical evidence, remains as relevant and as powerful as the day it was published. It is a framework that rewards careful study, that deepens with every market cycle experienced, and that provides a reliable compass through the inevitable uncertainties and surprises that markets will always produce. For any investor who takes their craft seriously, who wants to understand not just what to do, but why, and who is committed to the long-run discipline that genuine investment success demands, this framework is essential intellectual equipment. A final thought. Investing is ultimately an act of considered trust. When you invest, you are trusting that the future will be sufficiently like the past in its most important structural features that the patterns of history can guide your decisions. You are trusting that companies will generate profits, that economic growth will compound over long periods, that markets will eventually reward patience and punish irrational behavior, and that the global economy will create more wealth over the long run. These are reasonable assumptions, grounded in centuries of evidence across many countries and many economic regimes. But they are not certainties, and they require, in return for that trust, that you bring the very best of careful thinking, intellectual humility, and long-term discipline to the management of your financial resources. That is what Ilmanen's framework demands of those who engage with it seriously. Not just familiarity with the numbers and the concepts, but a genuine commitment to thinking rigorously about the future, a willingness to confront uncomfortable truths about realistic expected returns, and the patience to build and hold portfolios that are designed for the long run rather than optimized for the next quarter. The investors who bring this orientation to their work, who base decisions on careful evidence rather than emotion or consensus, who diversify genuinely rather than superficially, who set realistic expectations and plan accordingly, and who maintain the discipline of a sound process through the inevitable periods of difficulty. These are the investors who will look back over years and decades and find that the careful attention to expected returns was among the most valuable intellectual investments they ever made. The world of investing rewards those who are patient, who are honest about uncertainty, who think in decades rather than days, and who never stop learning from the evidence that markets continuously provide. There are few more powerful guides to that long and rewarding journey than the framework that Antti Ilmanen spent a career building, one of the most comprehensive and intellectually honest examinations of investment returns that the field of finance has ever produced.